Forex Trading 101. Essential terms you need to know. Hey there, and welcome to our channel. If you're new to the world of Forex trading, you're probably here because you've heard all the buzz. And let's be real, there's a lot of potential in the foreign exchange market. But before you jump in head first, it's crucial to understand the basics. Think of it like this. You wouldn't start building a house without knowing the difference between a hammer and a screwdriver, right? That's where this video comes in. We're breaking down some of the most essential Forex terminology that every beginner should know. This is your crash course, your Forex dictionary, your key to unlocking the exciting world of currency trading. We'll keep it simple, easy to understand, and by the end of this video, you'll be well on your way to becoming fluent in Forex lingo. So grab a notebook, get comfortable, and let's dive right in. Currency pairs. Your Forex building blocks. First up, let's talk about currency pairs. In Forex, you're always trading currencies each other, not just buying a single currency. Think of it like a seesaw. One side goes up, the other goes down. Each currency pair is represented by a combination of two three-letter codes. You've got your majors, like the EUR USD, Euro, US dollar, or USD JPY, US dollar Japanese yen. Then you have your minors, exotics, and regional pairs, each with their own unique characteristics and trading volumes. Why is this important? Well, understanding the dynamics of a particular currency pair, like their interest rate differentials or economic growth outlooks, can give you an edge in predicting potential price movements. Remember, Forex trading is all about speculation. You're essentially betting on whether one currency will strengthen or weaken against another. And it all starts with understanding the language of currency pairs. Exchange rates. The heart of the matter. Next up, we have exchange rates, the very core of Forex trading. The exchange rate tells you how much of one currency you need to buy one unit of another currency. Let's say the EUR USD exchange rate is 1.20. This means that for every €1 you buy, you need to pay 1.20 US dollars. Simple, right? But here's where it gets interesting. These exchange rates are constantly changing, influenced by a myriad of factors like global news events, economic data releases, even political instability. And it's these fluctuations, even tiny ones, that Forex traders try to capitalize on. By accurately predicting whether an exchange rate will go up or down, traders can buy low and sell high, or sell high and buy low to make a profit. Pips. Those tiny moves that matter. Now, let's zoom in on those exchange rate fluctuations and talk about pips. Pip stands for point in percentage, and it represents the smallest price move that an exchange rate can make. For most currency pairs, a pip is equivalent to 0.0001. Think of pips as the building blocks of profit in Forex. Even a tiny change in pips can translate to significant gains or losses, especially when you're trading large positions. That's why experienced traders keep a close eye on pips, analyzing charts and patterns to predict those tiny but crucial price movements. Understanding pips, how they're calculated, and their significance in relation to different currency pairs is fundamental to making informed trading decisions. Chapter 4. Lots. Sizing up your trades. Now, when you're trading Forex, you're not just buying and selling a few dollars or euros. You're dealing in lots, which are standardized units of currency. The standard lot size in Forex is 100,000 units of the base currency. So, if you're trading one lot of EUR USD, you're essentially controlling 100,000 euros. Don't worry, you don't need to have that kind of money lying around to trade Forex. That's where leverage comes in, but we'll get to that later. There are also mini lots, which are 10,000 units, and micro lots, which are 1,000 units, available for traders who want to start smaller. Choosing the right lot size for your trading style and risk tolerance is crucial for managing potential losses. Chapter 5. Leverage, the double-edged sword. Here's where things get really interesting and potentially risky. Leverage allows you to control a much larger trading position than your account balance would normally allow. Think of it like a loan from your broker. For example, with a leverage of 1 to 100, you can control a $100,000 position with just $1,000 in your account. Sounds amazing, right? Well, it can be. Leverage can amplify your profits, but it can also magnify your losses. It's crucial to use leverage responsibly and understand the risks involved before diving into leverage trading. Proper risk management strategies, like setting stop-loss orders, are essential when using leverage. Chapter 6. Margin, your trading safety net. When you're trading with leverage, your broker will require you to set aside a certain amount of money in your account as collateral. This is known as margin. Margin acts as a safety net for your broker, ensuring that you have enough funds to cover potential losses. Your margin requirement will vary depending on the leverage you're using and the size of your positions. If your losses start to eat into your margin, you might receive a margin call from your broker. This is basically a friendly or not so friendly reminder to deposit more funds or close some of your positions to maintain the required margin level. Managing your margin effectively is crucial to avoid those dreaded margin calls and protect your trading capital. Now, let's talk about how prices are quoted in the Forex market. You'll always see two prices for a currency pair, the bid price and the ask price. The bid price is the price at which you can sell the base currency, and the ask price is the price at which you can buy the base currency. The difference between these two prices is called the spread. Think of the spread as the cost of trading. It's how brokers make their money. Spreads can vary depending on the currency pair, the broker, and market conditions. Generally, more liquid currency pairs have tighter spreads, while less liquid pairs have wider spreads. Understanding the bid-ask spread is essential for calculating your trading costs and determining your potential profit targets. In the Forex market, you'll often hear the terms bullish and bearish. These terms describe the overall sentiment or direction of the market. A bullish market is one where prices are rising or are expected to rise. Traders who are bullish believe that a particular currency pair will strengthen and will buy the pair or go long. A bearish market is one where prices are falling or are expected to fall. Traders who are bearish believe that a particular currency pair will weaken and will sell the pair or go short. Understanding market sentiment and identifying bullish or bearish trends is crucial for making informed trading decisions. Technical analysis, fundamental analysis, and even sentiment indicators can help you gauge the direction of the market. In Forex, you have the flexibility to profit whether the market is going up or down. This is done through long and short positions. Going long or buying means you're expecting the price of a currency pair to rise. You're buying low and hoping to sell high. On the other hand, going short or selling means you're expecting the price of a currency pair to fall. You're selling high and hoping to buy low. Both long and short positions offer equal profit potential, and the strategy you choose depends entirely on your market analysis and trading plan. Remember, Forex is a two-way market, and understanding how to trade both long and short positions can significantly expand your trading opportunities. Now, let's talk about risk management, a crucial aspect of Forex trading that often gets overlooked. two essential tools for managing your risk are stop-loss orders and take-profit orders. A stop-loss order is an order that automatically closes your trade at a predetermined price level to limit your losses. It's like a safety net that prevents your losses from spiraling out of control. A take-profit order, on the other hand, automatically closes your trade when the price reaches a certain profit target that you set. It locks in your profits and prevents you from getting greedy and potentially losing your gains. Using stop-loss and take-profit orders is like having a trading plan on autopilot, helping you manage your risk and protect your profits. We briefly touched on the spread earlier, but it's such an important concept that it deserves its own chapter. As a reminder, the spread is the difference between the bid and ask price of a currency pair. It's essentially the commission or transaction fee that you pay to your broker for executing your trades. Spreads can vary widely between brokers and currency pairs. Generally, more liquid pairs, like the EUR-USD, tend to have tighter spreads, while less liquid pairs have wider spreads. The spread directly impacts your trading costs, so it's essential to factor it into your trading plan. Choosing a broker with competitive spreads can make a significant difference in your overall profitability in the long run. You'll often hear the term liquidity thrown around in Forex. But what does it actually mean? In simple terms, liquidity refers to how easily you can buy or sell a currency pair without significantly affecting its price. A highly liquid market means there are plenty of buyers and sellers, making it easy to enter and exit trades quickly. The Forex market is known for its high liquidity, especially for major currency pairs. High liquidity generally leads to tighter spreads, faster execution speeds, and less price volatility. Understanding liquidity and its impact on trading conditions is essential for choosing the right currency pairs and executing your trades effectively. Chapter 13. Volatility, the spice of life and risk. Volatility. It's what makes the Forex market so exciting and potentially nerve-wracking. Volatility refers to the degree of price fluctuations in a currency pair over a particular time period. High volatility means large price swings, creating opportunities for big profits, but also increasing the risk of significant losses. Low volatility, on the other hand, means smaller price movements, which can be good for conservative traders, but might not offer as many opportunities for quick gains. Volatility is influenced by a variety of factors, such as economic data releases, geopolitical events, and even the time of day. Understanding volatility and how to manage it is crucial for protecting your capital and making informed trading decisions. Title slippage. When your orders don't go as planned. Slippage is one of those Forex realities that can be frustrating, especially for beginners. It happens when your order is executed at a different price than what you requested. Imagine placing a buy order for a currency pair at 1.2000, but the order gets filled at 1.2005. That's slippage. Slippage usually occurs during periods of high volatility or low liquidity, where prices are moving rapidly and there aren't enough buyers or sellers at your desired price. While some slippage is unavoidable in Forex trading, using limit orders instead of market orders can help minimize the impact of slippage. Being aware of market conditions and choosing the right order types can make a big difference in getting your trades filled at your desired prices. Chapter 15. Hedging. Protecting yourself from the unexpected. Here's a strategy that's all about managing risk. Hedging involves taking offsetting positions in the market to reduce your exposure to potential losses. Think of it like insurance for your trades. In Forex, hedging might involve taking positions in currency pairs that are negatively correlated. For example, if you're long EUR-USD and concerned about a potential euro decline, you might hedge your position by shorting EUR GBP or another euro-related pair. Hedging doesn't eliminate risk entirely, but it can help mitigate potential losses and protect your capital, especially in uncertain market conditions. It's a valuable tool for traders looking to manage their overall risk exposure. Arbitrage is like the holy grail of trading, finding risk-free profits by exploiting price differences in the market. In Forex, arbitrage might involve taking advantage of tiny price discrepancies between different brokers. For example, if one broker is quoting EUR USD at 1.2000 and another broker is quoting it at 1.2002, an arbitrageur would simultaneously buy from the lower price and sell at the higher price, pocketing the difference. Sounds simple, right? Well, arbitrage opportunities in Forex are extremely rare and short-lived due to high-frequency trading algorithms that constantly scan the market for such discrepancies. While it's not impossible to find arbitrage opportunities, it's certainly not a sustainable trading strategy for most retail traders. While not strictly limited to Forex, contracts for difference, or CFDs, are derivative products that allow you to speculate on the price movements of various assets, including currencies, without actually owning the underlying asset. When you trade CFDs, you're essentially agreeing to exchange the difference in the price of an asset from when you open a position to when you close it. CFDs can offer several advantages, such as leverage and the ability to trade on margin. However, it's important to understand that CFDs are leveraged products, which means potential for amplified profits, but also magnified losses. It's crucial to carefully consider the risks involved before diving into CFD trading. Brokers. Your gateway to the Forex market. You can't trade Forex without a broker. Brokers act as intermediaries, connecting you to the interbank market and providing you with the platform to execute your trades. Choosing the right broker is paramount for your success as a trader. When selecting a broker, it's essential to consider factors like regulation, security of funds, trading platform features, spreads, commissions, and customer support. Do your research, read reviews, and compare different brokers before making your decision. Remember, your broker is your trading partner, so choose wisely. Chapter 19. Margin Call, your friendly or not so friendly reminder. Remember margin, that safety net we talked about earlier? Well, if your trades start going against you and your account equity falls below the required margin level, you'll receive a margin call from your broker. A margin call is essentially a demand to deposit more funds into your account to cover potential losses. It's a way for your broker to protect themselves from the risk of you not being able to cover your losses. Ignoring a margin call can lead to your broker closing some or all of your positions to bring your account back to the required margin level. Managing your risk effectively, using stop-loss orders, and not over-leveraging your account can help you avoid those dreaded margin calls. Chapter 20. Swap. The cost of holding overnight. In Forex, when you hold a position open overnight, you might incur a fee known as a swap or rollover fee. This fee is essentially the interest rate differential between the two currencies in the pair you're trading. If you're holding a long position in a currency with a higher interest rate than the currency you're shorting, you'll typically earn a positive swap. Conversely, if you're holding a long position in a currency with a lower interest rate, you'll typically pay a negative swap. Swap rates vary depending on the currency pair and the broker. It's essential to factor in swap rates when holding positions overnight, as they can impact your overall trading costs or profits. And there you have it. We've covered some of the most essential Forex terminology that every beginner should know. Remember, knowledge is power, and in the world of trading, understanding the lingo is crucial for making informed decisions. Of course, this is just the tip of the iceberg. There's so much more to learn about Forex trading, from technical analysis to fundamental analysis to developing your own trading strategy. But by grasping these basic terms, you've taken the first step towards becoming a more confident and knowledgeable trader. So keep learning, keep practicing, and never stop exploring the exciting world of Forex. Host. And there you have it. Those are some of the basic terms you'll encounter when you start trading Forex. Understanding these concepts is crucial for making informed trading decisions. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more Forex tips and tutorials. Host, happy trading, and see you in the next video. Happy trading and